Hey folks, John again, SPX Trade this Monday morning. Hair's looking a little unruly today, so we're going with the big blue hat. Go Michigan. So we're on the SPX 3-minute chart. You can see we had a little gap down. It looks more impressive than it is. It's actually only 11 points. But we came down this morning, gapped up to the 9 EMA, got shot back down. And we start to see our John Wicks slowly pushing back up. Here we see the reversal. I chose to make a strat 222 bullish continuation play. My entry was the middle of this wick right here. My stop was the bottom of this wick. And my sell point I chose was in between the Friday sessions low right before the run up and the gap. So it was a nice little sell point. All in all, I got in at 10 o'clock. I sold at 10:10 and 10 minutes for 50 bucks. You can't really beat that. You can see by open, I did a 40-15 call for 370, and I sold a 40-15 call at 420. So, why did I pick a 40-15 call? Well, with the current price at 39.78, I like to go 30 to 40 points out of the money because the contracts, honestly, because they're cheaper, and I don't have that big of an account. So if I played a 39.90 call with the current price at 39.78, that could have been in the $750 to $800 range instead of the $370 range. So you're putting more risk in, but it's a safer play because you're closer to being in the money. You're closer to your strike price or the price at which you want to exercise the option at. So we'll talk about some terms real quick. And where are they? Here we go. So strike price of an options contract is a price at which the security can be either bought or sold once exercised. So that's the price at which your target is. So my strike price was 40.15, also known as the exercise price. Difference between exercise price and the underlying securities price is if an option is in the money or out of the money. So with the current price at 39.78 when I bought, and my exit price and my strike price off the chart at 40.15, we are clearly out of the money. If I bought a 39.70 call with the current price at 39.78, that would be a contract that is in the money. So in the money options have intrinsic value since their strike prices are lower than the market price for a call or higher than the market price for a put. So what all that basically means is you kind of have built-in equity already. And if the price goes up even higher, you're going to see a bigger return faster than an out-of-the-money option that has to kind of catch up to the intrinsic value that's already in a call that's in the money. So that's a couple of defined things with the in-the-money calls. Out of the money calls, what's the strike price, exercise price, current price, they all tie together. And the only way you'll get to see the price action is by doing it yourself. Pricing out an option play that you want to make, checking out the different prices for how far you're in the money or out of the money. E-Trade is what I use. They have great examples. They're typically by fives. So you'll have 4,000, 4,005, 4,010. It'll give you the current prices for each of the contracts with those. And sometimes they do determine which ones I play based on how much buying power I have, which you can only use. I'm in a full cash account. I'm terrified of trading at margin. I don't want to be borrowing money that I don't have. I'll just deal with a cash account. And so I have settled funds, so I can only, if I have $3,000 in my account, I can only use $3,000 every day. At the end of the business day, before the next trading day starts, that money from all those contracts gets settled, and I have a clean slate ready to go for the next day. So anyway, hope you enjoyed the video, and take care.